There is a moment in every major financial shift where ordinary people can either act or watch from the sidelines as the window closes permanently. We are living inside one of those moments right now. And the tragedy isn't that people don't have access to the information. If that they have it, they feel the urgency deep in their gut. They nod along, and then the week ends and they did nothing. This video is for the people who are tired of nodding along. This is for the people who are ready to actually do something before this window shuts. Let me tell you something that took me a while to fully wrap my head around. Silver is not just a shiny metal. It is not just a relic your grandfather kept in a sock drawer. Silver is a dual force asset operating in two completely separate economic universes simultaneously. The monetary universe, where it has functioned as real money for 6,000 years, and the industrial universe, where demand for it is exploding at a pace we have genuinely never seen before in modern history. And when those two forces collide at the same time, pointing in the same direction, what you get is the setup for one of the most asymmetric trade opportunities of a generation. Let me build this case layer by layer, because I want you to understand it at a deep enough level that you don't second guess yourself when the dealer asks if you want to add more to your order. I want this embedded in your bones. So let's start at the foundation. The silver market is currently in its sixth consecutive year of a structural supply deficit. 6 years in a row where the world has consumed more silver than it has produced. Not 6 months, not 6 quarters, 6 years. And the gap isn't shrinking. It's projected to reach somewhere between 45 and 65 million troy ounces this year alone, depending on which analyst you believe. That is a staggering, historically unprecedented drawdown of above-ground stockpiles. Think about what that means. Every year that passes, the cushion gets thinner. The inventory that exists to smooth over short-term supply disruptions keeps getting smaller. And yet, here we are, and the mainstream financial conversation is still not talking about it with the urgency it deserves. Now, let me put that deficit in context, because raw numbers don't always land. Imagine you run a factory. Every year you use slightly more raw material than you produce. Year 1, fine, you have reserves, no problem. Year 2, 3, uncomfortable but manageable. By year 6, you are now watching your warehouse inventory drop to critically low levels, and you are praying nothing disrupts your supply chain, because if it does, you have almost no buffer. That is the silver market today. 6 years of drawdown, 6 years of living off stockpiles that were not infinite to begin with. And before I go any further, I just want to pause for 1 second. If you're watching this and you're at or near retirement age, and you have $100,000 or more sitting in a retirement account, I've put together a completely free guide that walks through the saving secrets thousands of American retirees are quietly using to protect their hard-earned wealth. It's sitting in the description right below this video. No strings attached, just real information. Check it out when you get a chance, and then come right back here, because what I'm about to show you about silver's industrial explosion is going to completely change how you think about this metal. All right, let's get into the industrial side of this story, because this is where things get jaw-dropping. Silver is not optional. It is not a commodity you can easily replace with something cheaper if the price gets inconvenient. Silver is embedded in the technological architecture of the modern green energy transition in a way that makes it essentially indispensable in the near term. Every single solar panel produced uses silver. Silver is used in the paste that forms the electrical contacts on photovoltaic cells, and as solar panels have gotten more efficient, specifically the shift toward newer high-efficiency cell designs, the amount of silver required per panel has actually increased, not decreased. The solar industry is now consuming silver at a rate that would have seemed unimaginable a decade ago, and global solar installation targets have not slowed down. They've accelerated. Then you layer in electric vehicles. Every EV on the road uses significantly more silver than an internal combustion vehicle for battery management systems, charging infrastructure, sensors, circuit boards, and a dozen other applications. And the shift toward electrification globally is not a trend, it's a mandate. Governments have committed to it. Automakers have committed to it. The infrastructure build-out is underway, which means the industrial demand for silver from the automotive sector is not going to plateau anytime soon. It's going to compound. Then there's 5G infrastructure, data centers, medical devices, defense electronics, water purification systems. Silver's antimicrobial properties make it critical in healthcare applications that are only growing. Every one of these sectors is a compounding source of demand that is not price sensitive in the way traditional commodity demand is. If a semiconductor manufacturer needs silver to complete a circuit board for a contract worth tens of millions of dollars, they are not going to skip the silver because the price has gone up. They are going to buy the silver and pass the cost downstream. That is what inelastic industrial demand looks like. So now take that structural demand picture and hold it next to the supply story. Silver mining is not a simple proposition. Finding new silver deposits takes years. Permitting mines in the current regulatory environment takes even more years. Most silver, roughly 70 to 75% of total mine supply, comes not from primary silver mines, but as a byproduct of mining other metals: copper mines, zinc mines, lead mines, which means silver supply is largely not responsive to silver prices. If a copper mine is producing silver as a byproduct and silver prices double, that mine is not going to crank up its output specifically to capture the silver price move. It produces silver as a consequence of what it was already doing. The price signal doesn't flow back into supply the way it does in other markets. This is a structural rigidity that the silver market has always had. And right now, with deficits running at record levels, that rigidity is becoming a very serious problem. Now let me take you back in time for a moment, because history has a way of showing us what happens when this specific kind of imbalance builds up to a tipping point. In the late 1970s, two brothers from Texas named Nelson Bunker Hunt and William Herbert Hunt looked at the silver market and reached a conclusion that had a certain internal logic to it. They saw inflation running hot, they saw the dollar being debased, and they saw silver as a hard asset hedge. They started accumulating physical silver in enormous quantities, and I mean enormous. By late 1979, the Hunt brothers and their associates controlled somewhere in the neighborhood of a third of the world's above-ground deliverable silver supply. Not a small percentage, not a meaningful position, a third. The price of silver at the start of 1979 was roughly $6 an ounce. By January of 1980, the price had exploded to nearly $50 an ounce, 8 to 900% in roughly 12 months. Now, here's the part of that story that doesn't get told enough. The Hunt brothers didn't cause that price move through manipulation alone, though regulators eventually came to different conclusions. What they did was exploit an existing structural reality. Silver had been chronically underpriced for years, and when large-scale physical demand hit a market with limited physical supply, the price responded violently. The fundamentals were there. The Hunt brothers just poured gasoline on a fire that was already burning. The reason I'm telling you that story is not because I think we're heading for a repeat of the Hunt corner. We're not. What I'm telling you is that the underlying market mechanics that made that price explosion possible, chronically underpriced metal, tight physical supply, inelastic demand, those same mechanics are more fully developed today than they were in 1979. The Hunt brothers operated in a market where silver was used primarily as a monetary metal and for photography. Today, silver has dozens of critical industrial applications that didn't exist then, and global investment demand for physical metals has never been higher because the macro backdrop has never been more conducive to it. Speaking of the macro backdrop, let's talk about what's happening in the broader financial world right now, because silver doesn't exist in a vacuum. We are living through an accelerating de-dollarization of global trade. This is not a conspiracy theory. It is a documented geopolitical process that has been underway for several years and is now moving at a pace that would have been hard to imagine even 5 years ago. The BRICS nations, Brazil, Russia, India, China, South Africa, and the growing number of countries that have joined or are seeking to join that bloc, are actively building alternative payment systems, alternative currency baskets, and alternative reserve frameworks that bypass the US dollar. This has enormous implications for the monetary premium that silver and gold carry as real money that no nation can print. Central banks around the world have been net buyers of gold at near record pace for multiple consecutive years. That alone should tell you something. These are not emotional retail investors chasing a trend. These are the institutions responsible for managing the financial stability of entire nations. They have access to economic research and geopolitical intelligence that you and I will never see. And what they are telling you through their actions, not their press releases, their actual buying behavior, is that they believe the era of unconditional US dollar dominance is transitioning into something different. They are repositioning toward hard assets. Here's the thing about that central bank dynamic that most people miss when they talk about silver specifically. Central banks buy gold, not silver. Silver has no reserve currency status among official institutions, which means silver gets none of that central bank floor under its price, none of that institutional buying that prevents gold from falling below a certain level. Silver trades purely on market forces. But here's the flip side of that coin. When the monetary tailwind that is driving gold higher starts to spill over into silver, when retail and institutional investors start looking at the gold to silver ratio and asking themselves why silver is still so dramatically undervalued relative to gold, that catch-up dynamic can be explosive. Let's talk about that ratio for a moment, because it's one of the most important signals in the precious metal space, and it's flashing something extremely significant right now. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, over very long time horizons, that ratio has averaged somewhere around 15 to 16 to 1. There's an old argument, rooted in geology, that silver is found in the earth at roughly 15 times the frequency of gold, so the metals should trade at roughly a 15 to 1 ratio. In practice, the ratio has deviated dramatically from that historical average for extended periods. But here is what you need to understand about extreme deviations in that ratio. When silver becomes historically cheap relative to gold, it has a documented tendency to revert, sometimes slowly, sometimes very suddenly, but it always reverts. Every single time in modern history that the ratio has stretched to extreme levels, silver has subsequently massively outperformed gold on the way back to equilibrium. Not slightly outperformed, massively outperformed. The ratio right now is sitting at a level that any serious student of precious metals history would describe as a massive, screaming buy signal for silver. You are getting an extraordinary amount of silver purchasing power for every dollar you spend, compared to what you get in gold. Which means if and when the monetary revaluation thesis plays out, when gold continues its climb toward the targets that even mainstream analysts at institutions like JP Morgan are projecting, silver's catch-up move has the potential to be dramatically larger in percentage terms than gold's move. And I want to say something here that I think is critically important for anyone watching this who is holding retirement savings in traditional financial assets and is genuinely uncertain about what comes next. The threats to conventional retirement portfolios are not abstract possibilities. They are real, documented, ongoing forces. The government debt trajectory in the United States and across the developed world is not on a sustainable path by any honest accounting. At some point, whether that's through inflation, currency devaluation, financial repression, or some combination of all three, the bill comes due. The people who historically have fared best through these kinds of transitions are the people who held a meaningful allocation to real, tangible assets that no counterparty can default on. Gold and silver have played this role across civilizations and monetary systems for thousands of years. They played it in Weimar Germany, they played it in 1970s America, they played it in every country that has ever experienced a currency crisis. Physical precious metals are not a speculative bet on the future. They are insurance against a monetary system that is showing serious structural cracks. If you've been watching this and you have a retirement account, a 401k, an IRA, a pension, and you haven't yet explored how to get physical gold or silver inside that account without triggering a tax event, I want you to know that's something I've helped thousands of people understand. I put together a comprehensive free guide on exactly how this works, how gold IRAs function, how to do a rollover without penalties, what to look for in a custodian, what the common mistakes are. It's linked in the description. If you have $100,000 or more in retirement savings and you're worried about what the next financial shock means for those accounts, this guide is specifically for you. It covers the mechanics, the protections, and why smart retirees are using this as one of the most important moves they're making right now to hedge against market collapse, currency debasement, and the geopolitical instability that isn't going away anytime soon. Take 5 minutes with it. You'll be glad you did. All right, back to silver and the COMEX, because this is where the story gets particularly interesting. Most people don't understand the difference between the paper silver market and the physical silver market, and that lack of understanding is costing them clarity. The COMEX, the commodity exchange where silver futures are traded, is a market where at any given moment there are claims on silver that vastly exceed the amount of silver that actually exists in registered vaults, available for delivery. The ratio of paper silver claims to actual deliverable physical silver has been eye-watering at various points in recent years. The way the system is supposed to work is that most futures contracts are cash settled or rolled forward. Very few players actually take physical delivery. But here's what happens when a real, serious physical demand event hits a market structured this way. The physical market can disconnect from the paper market. Physical silver can command substantial premiums over the spot price. And if enough people and institutions simultaneously decide they want physical delivery rather than cash settlement, the entire pricing mechanism gets stress tested in a way it wasn't designed to handle. We have seen early versions of this dynamic. The retail silver squeeze that went viral a few years ago, remember that? Dealers selling out overnight, premiums exploding, wait lists forming for eagles and maple leafs. That was a tiny preview, a rounding error in scale compared to what a genuine institutional scramble for physical silver would look like. The infrastructure stress that caused, the premium spikes, the inventory shortages, all of that happened with a relatively modest spike in retail buying. Now imagine what happens if even a fraction of the institutional money currently analyzing this supply deficit story decides it wants exposure to physical silver. The math gets very uncomfortable very quickly for the paper side of this market. And this is what brings me back to the title of this video. Do not let the week end without stacking silver. I'm not saying that as a throwaway phrase designed to create artificial urgency. I'm saying it because the window of time where you can accumulate physical silver at a price that still reflects the old paradigm, the paradigm where silver is a neglected orphan in the financial world, where the industrial revolution it's powering hasn't yet been fully priced in, where the monetary awakening that's driving gold is only beginning to translate into silver demand, that window is closing. Not all at once, not in a single dramatic moment, but incrementally, week by week, as more people do the research you're doing right now. The single most common thing I hear from people who discovered silver late is some version of, I knew, I read about it, I watched videos like this one, I just didn't act in time. They had the information, they felt the conviction, and then something mundane got in the way. The week got busy. The price moved slightly higher and they decided to wait for a pullback. They talked themselves out of it over 100 small hesitations. And then they watched the price go somewhere they never expected it to go, and they were on the wrong side of history. Here's what I want you to do before this week ends. I want you to make one concrete step, not a life-changing commitment. One step. If you've never bought physical silver before, go buy a single roll of silver American Eagles or maple leafs or whatever is available from a reputable dealer in your area or online. Feel what it's like to hold real money in your hand. Understand the difference between a number on a brokerage screen and a physical asset that is fully yours, outside the banking system, outside the counterparty risk matrix that every financial asset you own in a paper form is exposed to. One roll. That's it. And then, when you've done that, come back and we'll talk about building a real position. Because here's the truth about silver at this point in the cycle. The people who are going to look back at this period with tremendous satisfaction are not going to be the people who had the perfect entry, who timed every dip and sold every rally with precision. They're going to be the people who simply accumulated physical metal consistently, who understood the thesis, who trusted the structural story, and who held through the volatility because they knew what they owned and why they owned it. Silver has been the monetary metal of the common person throughout human history. Gold went to kings and central banks. Silver went to merchants, farmers, craftsmen, people who needed real money they could transact with, store value with, and trust across generations. There's something deeply fitting about what's happening right now, where the industrial revolution of the 21st century, solar panels on rooftops, electric cars in garages, semiconductors in every device, is being powered in part by the same metal that has served humanity as honest money since before recorded financial history. Silver is bridging the ancient monetary world and the technological future simultaneously. And if you understand that, really internalize it, then stacking silver isn't just a financial decision. It's a statement about where you believe the world is going and what you think real, enduring value looks like. The deficit is real. The demand is structural and growing. The supply response is constrained in ways that cannot be quickly fixed. The monetary tailwinds are powerful and accelerating. The paper market is fragile in ways that few people fully appreciate. And the price, relative to gold and relative to the inflation that has ravaged the purchasing power of cash over the past several years, is still extraordinarily compelling. Do not let the week end without taking some kind of action on this. The information is in front of you. The case is as strong as it has ever been. The only variable left is whether you act on it. And one final thing before you go. If you watched this entire video, I want to give you something specific. The free guide in the description isn't just a generic precious metals overview. It includes a section on how to get a complimentary, no obligation, one-on-one educational web conference, completely free, where we walk through your specific situation, your retirement accounts, and what a real metals strategy could look like for your financial picture. This offer is exclusively for American retirees who have $100,000 or more in any retirement account. When you reach out, just mention that you watched through to the end of this video. That's the signal that you're serious and that you've done the work to understand what's at stake. The spots for these sessions are limited. They go to people who mention they watched all the way through, and they go fast. The link is in the description. Go check it out right now. You've done the research, now do the stacking.